course, all of the attention will be focused on the rupee. Let's get in more details. We've got Ashutosh Khajuria, President, Treasury Federal Bank, who now joins in on the show. Ashutosh, if you could just walk us through the kind of measures that you're expecting this time around in order to curb the fall that we've seen in the rupee.
See, expectation is going around, making rounds that it could be hike in investment in rupee debt by FIIs. So if that gets relaxed, I think because everybody is expecting interest rates to go down in India, and if that cap is removed, because presently we have about $15 billion that can be invested in sovereigns, then you have another 20 that can be done in corporate bonds, and another 25 that can be done for infra. So if these limits are increased, we can expect more flows coming into India to capitalize on the yield curve movement, the yield fall, which is expected.
Right. Now, Mr. Khajuria, even if we do have...
Yeah.
Sorry, go ahead.
Yeah, I was saying that this is one area where, the expectation is that some money may flow. But let me share some of the, interaction which I had with my Federal Bank constituents and the various other industrialists. What's happening is some of the items which earlier were quite competitive when you were sourcing it from overseas, they have become, they're no more competitive now. Like I would just, give one example. It's steel scrap. Now, with the rupee depreciating to above 57 and all, I think it was cheaper now to source scrap, to melt it and convert it into steel ingots and source it domestically. So there are some items wherein I would see import contraction, and therefore there could be trade deficit that had widened to as high as something like $17 to $18 billion a month may come down. So import contraction could be one area. Rest, from the government side, it could be maybe, putting in some of those, duties or so to reduce imports. That could be one part. Or maybe more, welcoming more of inflows on the capital side, because on current account side, we are running nearly 4% of deficit, 4% of GDP as current account deficit. I expect more to come on the capital account side.
Right. Now, Mr. Khajuria, even if we do have, like our reporters have been indicating to us from Delhi, the FII investment limit cap on both G-Secs and corporate bonds being increased, should we expect that these fixes, so to speak, will be short-term in nature, that in the immediate term you'd possibly see the rupee go, maybe above 56, maybe, go to levels of 55, 50 even, that after a while we will start focusing once again on fundamentals, and then the rupee will come back under pressure again?
Yeah, absolutely right. I fully agree with you. It's basically to change the mood. Because right now what you need is more of, confidence coming back to the system, and people thinking that some measures are going to be taken, and it's not policy paralysis as a whole. Basically what we need is to change the mood. And I think a bit of it done on the capital account side and part of it to be done on current account, both would help a lot. And I'm not expecting it to go to 52 or 51 levels or so, because I think the type of trade deficit that we are running, the type of current account deficit that we are running, because $189 billion you cannot sustain. $185 billion, sorry, because with $489 billion of imports, and if you project even 15 to 20% growth in imports, practically what you're going to have is your reserves are less than 6 months of imports. So I think what is now needed is to get some capital inflows coming into India, and for that I think it could be anything, and I can't guess right now. It could be some relaxation on the retail side, or maybe insurance or so, despite politically being little difficult. But I think I'm expecting on those in those areas also.